Hey, hello. Welcome to Markets Next Week, the weekly stock market analysis show where we look at the technical charts and try to understand what happened in the market in the previous week and also plan for better trading for the upcoming week that's starting from tomorrow, October 28th, Monday, 2024. Let's get into the charts first. This is the weekly of Nifty on the left side. You can see that it's hit the top of the trend line and then sliding down since last 4 weeks, and the right side the daily charts are showing that it just breached a trend line parallel channel, and the Banknifty you see an ascending wedge, and that wedge bottom is still not broken on the Banknifty. While on the daily charts you see that it's still moving within that trend line parallel channel, and you see a head and shoulder neckline also coming somewhere at the bottom of the trend line. The head and shoulder on the daily on Nifty is already breached. We see that. So overall, we see that there is some correction that's going on. So what is the amount of correction? Yeah, it's a 4 consecutive week of red, and the second big red that has happened. It's a deeper cut of 3% once again at 676 point. We had another deeper cut 3 weeks back. Now another one has come in with a deep crack down, and it has lost the 20, 50 and 100, all of them. So the correction is extended to 8.4%. 8.5% of Banknifty is being retested. So Banknifty has also lost the grip. It is showing more strength previously as compared to the Nifty. This week 12.5% more, 310 points lost. It's below the 20, 50 and 100 again, and correction in both the indices are 8.5%. Right, that just happened in the last 4 weeks. So wide range bearish candle on the weekly on the Banknifty. That's a bearish engulfing candle that you see on the Banknifty, and a wide range on weekly candle also on the Nifty. We could see this. So this is Nifty on the left side weekly candle, wide range bearish candle. This is bearish engulfing candle on the Banknifty weekly. Daily charts are clearly showing head and shoulder on both of them, and wide range bearish candle. Right, so the correction is clearly visible. The 8.5% of correction. That's what it's mentioning. So this seems to be a support zone earlier. Now it seems to be a support zone. Earlier it was a resistance zone from where big breakout happened. So change in priority bounds could work out here. It's the same in Banknifty as well. Now, interesting thing is the Bollinger Bands on the daily. You see the expansion with Nifty, and Banknifty it is a contraction. So Banknifty seems to be more interested in consolidating with a bearish bias, of course, below the median of the Bollinger Bands, but Nifty still in the expansion mode, and they'll get more corrections, and also it could happen. Looking at the momentum, the trend, we are using the RSI for the momentum, and the trend is ADX. We're trying to understand both the time frames of weekly and the daily both, and you see that it's slipped sideways and it's falling further down. Actually, Banknifty has hit the resistance zone of size 60, and then it's even more bearish and indicates more fall. So momentum is in the sideways in the falling mode in the medium term. That's the weekly charts, and then on the daily charts, it's Banknifty clearly about to slip into the sideways into the bearish zones of RSI below 40. Not that happened, but it is already plunged into the bearish zones previous week itself below the RSI 40. So overall bearish momentum is what we can see in the short term, and sideways momentum on the medium term. And ADX, that's the trend indicator, as you see down here. If you try to understand, it remains bearish, and it's increasing the bearishness on both indices. That's correct. Right side, what you see here is the India week's charts, which seems spiking up. It's 12% more of spike up that has happened last week when the market corrected, and it's 14.63. It's very close to 15, which is no longer the low voltage regime. So VIX is spiking up. There is fear in the markets. Open interest analysis of the futures is showing that Friday we had a long unwinding on the Nifty and the short build up. So overall bearish build up is what happened. The futures high, with options so high, the PCR for the next week monthly expiry that's coming on October 30th and 31st, and Banknifty and Nifty respectively is bearish. PCR is 0.75 and PCR is 0.64. They're both bearish. Put call ratio is what PCR is all about. Now if you look at the support and resistance levels based on the options, so I see that the highest call put writing is in at 23,500, second highest is at 24,000. The highest resistance is coming in 24,500 when the maximum call writing is seen. Then comes 24,400. So yeah, definitely bearish bias like you see here. Low resistance build up. Banknifty is 50,000 and 51,500 where the highest put and call writing is seen. The second highest put and call writing is at 49,500 and 52,000. So PCR and futures where YI build up is negative. We already seen that. Another way of finding the support resistance is from the technical charts using the different techniques of moving averages, the Fibonacci retracements, and the previous resistances, previous swing lows, etc. It's marked here clearly. So basically, the major resistance is going to come at 25,000 nearby, somewhere the confluence of the 50 and 20 exponential moving averages there. And after that, we'll look at that, but that's a major hurdle. Downside, the previous swing lows that comes at 24,000 would be crucial. Bridge of that could take it to 100 exponential moving average support, which is at 23,350 zones. Let's take brief. Banknifty on the other hand, the major resistance again would be clear with the green close around at 51,673. That's where the 20 and the 50 exponential moving average resistance is there. Once it is clear, you'll find resistance will get near the 53,000. Downside, the major thing is that support that comes into the 50,000. That's near to the previous swing low and the Fibonacci 50 and all that. That is breached, then 200 moving average support comes in at 49,445. That's where the supports are coming. So similarly, if you try to understand, it's the levels are marked here. Make a note of this. Correlate that with the open interest levels that we have, and then identify your support resistance and place your bets accordingly. So demo is daily exponential moving average, and RL is rounding number, PR is previous resistance zone, and PSL is previous support zone. Fib is Fibonacci 50, Fibonacci 61. Right, those are the levels. Support resistance, make a note of this. Let's move and see what did the sectors do last week. So it's red all over. You can clearly see that, right? And Nifty IT is the only one that didn't correct much and remains to be bullish on medium term. But otherwise, all the other sectors have fallen to the sideways zone on the medium term charts, like you see on here. From CG, the auto, the pharma, the metal. Here what you see is metal up there on the auto index, falling to sideways. Pharma falling to sideways. Pharma is maintaining the bullishness in the medium term. So pharma and IT is falling because they are defensive sectors, IT and pharma. Otherwise, FMCG fallen sideways, and reality also fallen sideways. So all the four charts fallen sideways, sectoral indices, except the IT and the pharma, that's holding all the bulls on the medium term. But the correction that has happened, if you see, it's only the IT has closed flattish down. All are down. It is flattish down. Rest is all big downfall. 7% on metal, 7% down on reality. Pharma 3.3%, auto 5.3%, FMCG 3.5%. So big fall. So just have to wait before taking any long versions. It's corrections happening, and it's across the sectoral indices where you see corrections. If you try to understand the industry heavyweights that contribute maximum indices, the one that's doing good is HDFC, just climb back to the momentum RSI and then try and do another attempt to break out of that. But the volumes are less, make note of that. If it breaks out, then it can lift, and the Nifty also can get lifted when the Banknifty lifts. So major contributor of both indices is HDFC Bank. So volumes are less, that's the only thing. But otherwise, it's a good move. That's only stock that's holding the market. Well, else correct Correction ongoing, almost following the bear zones in the medium term as well. HDFC Bank holding good above RSI. So HDFC Bank and HDFC Bank, that's what is making the bank index also not that bad shape as compared to the Nifty. Nifty fallen sideways, TCS is fallen sideways, Kodak Bank as usual sideways, and then ITC is also, since FMCG is correction, has fallen to the sideways. So ITC Bank, HDFC Bank holding it good, Lions in trouble, IT just holding on, and Kodak Bank as usual sideways, and even ITC in trouble. So let's see if this bank stocks, HDFC Bank and HDFC Bank would hold the indices there or not. Right, so let's keep a close watch on that. So otherwise, if you see, it's a true just badly hit this week, and short term they're all in bear zones, and then medium term they're all falling to the sideways, and heavyweights, all got hit back except the two banking stock that is there. Global market also deep corrections of nearly 10% corrections happened in the big cap and small cap. You can see the big white range fall. There's a big crackdown trend after a fabulous rally of several months together. There is correction that's happening in the broader market indices as well. So make note of that. So that's some of the different. That's really what happened in the market. That's the story on the price, momentum, volatility, and all of that on the market. Now, why did it happen? Here's the culprit. The fire so 20,025 crores. That makes nearly 90,000 crores of selling just in the October month in 3 weeks or 3.5 weeks. So domestic institutions are buying still. They bought more. Net to net, it's 22,900 crores of buying that has happened from the domestic institutions. So it's a mutual fund money. Retailers are buying in when the market is correct. That's the strength, that's what is holding the market. But if I am selling is a concern. Imagine if I stop buying. Imagine if the DIs are also selling. The market would have corrected 20% by now. Markets are doing it slow just because of the DI buying. The derivatives also, net longs have come down. Right, we can see the numbers here. Now let's try to understand what happened in the global market, and the global commodities and the currencies and the US mother market. Let's begin with the currencies. So dollar has spiked up. Currency also getting weaker. Rupee is getting weaker. It's at 84.07 on the US dollar. Bullish momentum rising. Dollar rising up. Momentum sideways and almost getting the bull zones. But then on 1% more. So dollar is spiking up is not that great. Rupee getting weaker and weaker is neither great. Crude oil is spiked up this week. Obviously there is a war news that has come in Saturday on the Israel conflict, and it's further likely to move towards the 77 levels on top of the channel. Let's hope it does not break the channel top. If it breaks out from here, then we may have trouble, and it's likely to happen if the war intensifies in the Middle East. So it's 68.78, which is there's some mistake. 91.62. That's right. Sorry about that. That's it. So crude is rising up and it's likely to move. Now gold, look at that. That's it. It's hit another all-time high near to 2,740. So money is getting shifted to safer havens. Keep note of that. So it's a 26% or more kind of rally that has happened just in 2024 January onwards. So the bull zones and rising up crazily. Gold is at all-time high. Oil is spiking. No good news for the equity market. Global markets, you see a deep red on Dow Jones. That's a 2% plus 2.5% correction that has gone Dow Jones. Nasdaq also 2.5% correction, and it's flattish close on the Nasdaq. It's flattish close on the Nasdaq and deeper correction of the S&P 500. So all US markets are very close to the all-time high despite all the. But we see a red color here after a couple of weeks, so make note of that. The US market is red. There's some global tensions. Gold is spiking up, crude is spiking up, and the currency is getting weaker. So global cues are also great. Let's stop it there and then get into some action versus topics. Obviously in the short side alone. So India not intermesh is it's a sell because momentum is slipped to the side, slipped to the bear zones, and trend is climbing up in the bear zones, and it's a good risk reward trade of 1:2. That stop loss is though in the mid, Adani Enterprises also is a breach of the trend line channel. Wide range bearish candle, volumes are good on both on the downside, and trend and momentum indicators are in the bear zones, so it could give a risk reward of 1:2 on this as well. So 2 short trades in the India Mart and Adani Enterprises. So we have the FNO strategy for the next weekly expiry. It's a simple bear call spread, weekly spread basically. So basically we are selling near to the ATM call options and then covering that, hedging it with 24,500 call itself, buying that. Risk reward is not that great, but get out in 1 or 2 days, and not trying to adjust the premiums are very less. Profit is also not that great, but yeah, that's the best rate. The premiums are very low for some reason at this week's level, and it's the only way you can play. When the market is falling down, played on the same direction, but cover it in case it reverses. Right? That's completely hedged, risk defined FNO strategy, bear call spread for the next week. Let's just wrap it up. The market has cracked down and then slipped for the down. And the Banknifty also gave up. Banknifty corrected earlier to 8.5%. It was trying to recover, but it was holding on till last week, even when the Nifty was falling down now. Got on corrected 8.5% and then fall to the bear zones with respect to the momentum and the trend. But the FIs are continuously selling. So the correction overall is 10 to 11% maximum that has happened. We still have not reached that correction point this time. But the overall bull rally is nearly 72% if you take that previous swing lows from the June 2022. So big bull rally, still a small correction. More corrections are due, could happen anytime. Not that I find reasons for that fundamentally, but technically more corrections are expected for a healthy further up move. If you try to bucket to other different parameters that's in favor of the bulls and the bears, is it a stage of polarity zone where the previous resistance could act as support and a bounce could happen from here? That can be seen on both the indices. And Banknifty Bollinger Bands are not expanded now on the downside, it's contracting. It's also positive that they get some consolidation instead of breakdown. And domestic institutional money is flowing like anything. So my own debt is happening like anything. That's all factors in favor of the bulls, but more factors in favor of bears. Candles are bearish, engulfing white light bearish candles on both indices. Momentum is bearish, trend is bearish. Bearish build up on bearish PCR. FIs heavy selling. Bollinger Bands expanding on Nifty. Bollinger Bands are having bearish momentum. 20, 50, 100 all expansion moving averages last weeks is rising up 12%. US indices are at all-time highs, but deep red is shown in the Dow Jones. Total market is also impacted now and getting into correction. So caution need to be exercised. Global cues are not great apart from what we analyzed. We have Middle East crisis, we have US election outcome in November first week, we have the Buy China, Sell India campaign by the FIS. They're not that great. Local also quarterly results are not that great, so market is finding reasons to correct. So technically charts are showing correction, charts are bearish bias. So view for the next weeks is moderate bearishness. Global cues like war, pandemics and all that could screw up technical analysis, and deep, big, quick corrections could come in when the fear and uncertainty comes in. So you have to keep that in mind that black swans can come in any time. So all that you'll do is hedge your positions and then protect your capital, portfolio level and the position level. And for the next week, it's 23,000 and 25,000 where the levels are seen on the Nifty, and 49,500 and 52,000 on the Banknifty. Now, if the market is not able to climb back to the 26,000 and 54,000 on the Nifty and the Bank respectively, then the condition of rally is not there. It's either consolidating or bearish bias. So if that is happening, then the next leg can begin from there. So that's all I have. Play it safe. Market is in correction mode. More corrections could come in. DIs are strong, but the FIs are selling heavy. Global cues are pure. Play it safe. That's what I have. Thanks for watching. Happy trading, happy learning, happy investing. Bye bye.